Exchange Rate Policy and Full Employment by Warren Mosler. Devaluation Risk. There is no risk of the monetary authority running out of U.S. dollar reserves to present to holders of actual convertible Hong Kong dollars. It should always have more U.S. dollars than it could ever need if for no more reason than it earns interest on its U.S. dollar reserves and pays none on its Hong Kong dollar issued. That being said, should the monetary authority intervene and lower Hong Kong dollar rates by making purchases with newly issued Hong Kong dollars, perhaps to fight unemployment, it is now putting at risk that many more of its U.S. dollar reserves. If it issues more Hong Kong dollars than its supply of U.S. dollar reserves, there is a real risk of forced devaluation. Apart from such excess issuance, there is the risk of devaluation implemented not to protect U.S. dollar reserves, but to stem deflation and economic collapse, particularly as tight U.S. fiscal policy is automatically transmitted to the Hong Kong dollar via the currency board mechanism. The Hong Kong economy must somehow earn U.S. dollars for the Hong Kong dollar money supply to expand with economic growth. And if it borrows U.S. dollars, it must then service the debt with interest payments of U.S. dollars. The only net supply of U.S. dollars necessary to support a growing Hong Kong dollar money supply is net exports. With world U.S. dollars prices falling, Hong Kong is forced to accept lower prices for its exports, reducing wages and other Hong Kong dollar input factor prices the exporters can pay. This leads to a general deflation and the usual banking problems associated with deflation and falling asset prices. Hong Kong dollar prices will continue to fall until exporting firms are again profitable. Falling Hong Kong dollar prices is the method by which the real Hong Kong dollar money supply adjusts. The real pain of such an adjustment could make the alternative, and perhaps less painful, adjustment of simply devaluing the Hong Kong dollar politically appealing. Read Bloomberg News report on Hong Kong economy down 7% last quarter. I have all but skipped over the question of what to fix a currency to. Gold has been historically popular, but note that if the U.S. had been on a gold standard over the last few years, and all relative price movement has stayed the same, the move in gold from $400 per ounce to $300 per ounce would have been expressed as a jump in the general price level of around 35%. No doubt, the Fed would be raising rates aggressively to fight this inflation, while net holders of U.S. dollars would be screaming bloody murder. This applies to any fixed versus floating exchange rate policy in exactly the same way. For example, in local currency terms, those currencies pegged to the U.S. dollar have experienced deflation, while those with floating currencies, inflation. Over time, I suspect the nominal wage for unskilled labor is probably the most stable price in any economy, which supports the contention that the buffer stock employment model maximizes nominal price stability in a market economy.